Hello, and welcome back to TNC. As a beginner investor who hopefully subscribes to and applies long-term investing principles with some degree of discipline, a key cornerstone is diversification. So why is that important? Today's video is all about answering the question, why is individual stock picking generally a bad strategy compared to, say, buying into a market-wide fund consisting of hundreds and thousands of holdings? So I took a little break from uploading videos, but now I am back. I am, however, going to change up my posting schedule a little bit. It was pretty unsustainable because, you know, I'm holding down a full-time job. So I hope it's going to be once a week, but I don't really want to commit to a regimented schedule. But instead, I will post whenever I have time. So it does take a lot of energy and time to produce one video, and it's a one-man operation here. But I do want to thank all my friends and subscribers who have been encouraging me to keep up with what I'm doing. Please remember to like this video and subscribe to my channel, which will go a long way in building this channel and motivating me in doing whatever I'm doing here. Anyway, jumping straight into today's video, I want to continue what I was talking about in my previous video on the importance of long-term passive investing and some of the benefits of long-term exposure in the market via mechanisms such as dollar cost averaging and why you shouldn't time the market. So the link to that video is up here and down here in the description box. So that was in some form diversification and risk mitigation across time, which is staying in the market during all trading days to have the profiting days average out the losing days because it's impossible for anyone to predict with foresight which will be which. Now today I want to follow up on that concept of diversification. I want to argue today in favor of why someone who is starting out, and really any investor in general, should avoid picking individual stocks like the plague. Humans are greedy and we all want to pick the next Apple or Amazon that saw an amazing multi-fold increase during the 2010s. You know, taking this week, for example, market index such as the S&P 500 or the Nasdaq 100 or the Dow Jones Industrial Average saw an average increase of about 2 to 3%, whereas an individual company such as Boeing saw an increase across the month of May, really, of like almost 50%. So obviously a lot of people are going to look at compare these two sets of numbers and be like, why the hell didn't I just put all my money into Boeing to begin with? Why does everyone say that we need to diversify across many different stock holdings? If I just held a broad market index such as the S&P 500, which is of course the weighted average of the 500 largest publicly listed companies in the US, I would have made far less than what I would have had, if I held on to only Boeing. So similarly, someone else might make an argument that, if I didn't buy into the S&P 500 in 2009 and bought solely into like a big tech company like Amazon, I would have increased my initial capital by 31 times, than if I played it safe and just bought into the S&P 500, and during the same period of time, I would have increased to 3.6 times of my initial capital. So those might all sound like very good arguments, okay, on the surface, but it really is not. First of all, hindsight is 2020, which is why everyone sounds like the smartest genius investor that came to the face of the earth when they have access to historical data. In reality, investing doesn't really work that way, right? Investing is forward-looking, and the future is largely unknown, and the future will most certainly not look like the past. One of the most important things in investing is that past returns do not predict and guarantee future returns. Now, although in many cases they do show strong correlations, that really is because long-term human sentiment and behaviors don't really change very much, and they do have statistically significant continuities. So even for experienced investors and traders, human nature would lean towards overconfidence in knowledge of how the market works. The truth is that even the best investors like Warren Buffett do not rely on individual stock pickings, although in Buffett's case, he does pick such a broad range of diversified stocks. It resembles a market index more than anything else. And if we do not have foresight into the future, and if we cannot lean on hindsight for analyzing what stocks to pick and what stocks not to pick, and what stocks will outperform the market, then the smart strategy, right, is to not pick stocks. This is why 92% of all actively managed funds in the last 15 years have trailed S&P 500 market index. Here's another key statistic that will hopefully lend some strength to the argument against stock picking. So a 2018 paper by Bessembinder of Arizona State University finds that since 1926, only 86 stocks have accounted for half of the wealth accumulation in the market, which is the increased share prices multiplied by the number of shares. What is even more revealing is that, the entirety of the wealth creation in the market has been accounted to just 4% of all stocks. Now, it will be easy to say that you or an active manager will be able to identify those stocks, that 4%, right? With the help of hindsight, it is certainly possible to identify those who manage to do so, but it will be much harder, for example, to identify a fund or fund manager who persistently beats the market over the 90-year long-term horizon. It will also be near impossible to claim that you have the predictive insight to continue picking the 4% and only the right 4% of the stocks into the future. Here's another perspective. A recent Dimensional Funds Advisors paper shows that if we were to just reduce the number of stock holdings in a given fund from 1,000 to 50, then the probability of matching or beating a given market index or market average will decrease by 32%. So in other words, when you decrease the number of holdings in your investment portfolio, that is to say you decrease the diversification of holdings of stocks in your portfolio, you intuitively decrease your odds of capturing the 4% of stocks that account for the entirety of wealth creation since 1929. Now, this really is because individual stocks by individual companies introduced the idea of idiosyncratic risks. That is the risk associated with the unique decisions and business models and also vulnerabilities of individual companies. So these risks are often unexpected and unknown. On the other hand, there are systematic risks. These risks are far more known and far more expected. One such systematic risk would be the equity risk, which is the additional risk that you take on when you invest into equities or stocks, right? Rather than, say, a very safe traditional financial instrument such as the US Treasury bill or T-bills. While with systematic risks, you would have expected premiums, which is the additional reward and return for taking on such a risk. Investing in an equity index or equity market average, rather than say bonds or T-bills, you are expected an overwhelming percentage of the time, something like 90% of the time, to be rewarded with a positive premium, which is that you will get an additional return for investing in a higher risk asset. The problem with idiosyncratic risks associated with picking just a few individual stocks or companies is that it introduces a very large amount of risk with uncertain premium. So sure, it can be a very large positive premium, rewarding you with very high returns, unexpectedly far larger than the market return, such as what had happened with Tesla and Apple and Facebook. But the pendulum swings the other way as well too. So for example, one tweet from Elon Musk and your share price might dip by 10%. So on the retail investor level that is much closer to you and I, think of it this way. So I've seen friends and acquaintances and even fellow Singaporeans in the personal finance, investment and YouTube scene showing off and even advocating for portfolios where they hold 75% in Tesla or 100% equities in 4 or 5 energy and oil stocks, or like 30% of their portfolio is in SIA, just because it's, quote unquote cheap. Or even like the much more mainstream notion of retail investing in Singapore is to hold 4 or 5, key and supposedly safe blue chip stocks, such as DBS, OCBC, or Singtel. And I will do a video in the future about why I'm not a fan of Singaporean stocks and I would avoid them. And it can even be, buying 4 or 5, diversified exchange traded funds or ETFs, but concentrated in just 1 or 2 sectors like healthcare or energy. I see way too many of these examples. I am really not a fan of these. They all fall into the poor diversification trap illustrated extremely clearly and abundantly in existing financial economic literature that I just presented to you. So stock picking really is an emotional decision. You pick stocks because you believe in a company's mission and its future potential. You pick, for example, a couple of blue chip stocks in Singapore because you have seen them pay good dividends in the last few years, and you are sure, with cases like SIA, the government will swoop in and bail them out and everything will be fine. You might pick a couple of sectors such as energy or healthcare, because you believe and you bet and you gamble on these sectors going booming in the future. So this is gambling. This is pure speculation, right? So this is using past historical performance to inform future decisions, and not to mention interpreting these past indicators rather poorly. So the reason why passive investing is king and unbeatable, as I've mentioned in the previous video, is that because it takes all these elements of emotions out of investing as it should be. Don't get me wrong, right? Investing is not an exact science, and you should be doing whatever gives you the best peace of mind. And there's no point in sticking to an investment philosophy that you don't buy into. And if you don't buy into it, you wouldn't have the discipline to keep at it. And if you don't have the discipline to keep at it, you will not be getting any sort of the returns that you're hoping to get. So if stock picking tickles your bones and instills some sort of discipline to keep at it, then go ahead and do it. If it sparks joy, well, why not? But if you're going to be, for example, 75% in Tesla, okay, which is one singular stock, as some Singaporean YouTuber out there, financial guru out there is advocating and is showing off. I'm not going to name names, I'm not going to throw shade, but I just feel like, doing that is just at best fiscally irresponsible and at worst morally reprehensible. If you really want to pick stock, then limit your individual stock picking to say a maximum percentage of your overall portfolio and position. So there are some core periphery investing portfolio models out there that suggest that you should have 80% of your investments in a core portfolio and 20% in a peripheral portfolio. So your core portfolio should adhere to your long-term, diversified, broad market-based ETF strategy, for example. And your 20% can essentially be like a sandbox where you can do whatever you wish to do. So in this 20%, you can be experimenting and playing around with individual stock picks. I don't mind that. But you need to contain the idiosyncratic risks of individual stock picks to just that 20% of your portfolio, and you have to be very disciplined in doing that. Well, at the end of the day, the truth is more likely than not, you won't succeed at stock picking. So to be more precise, given the historical data, as an investor, you are more likely not to beat the market with stock picks 92% of the time, and 96% of the time, your stocks will at best match and at worst trail the market index or market average. Then the question remains, why would you introduce unnecessary idiosyncratic risks? Why risk the opportunity cost of missing out on healthy market average returns? The most sensible retail investing strategy, therefore, is a long-term passive one using a low-cost fund or ETF to track the market index or average. So that's it for this video. I hope you found it informational and useful. In the next couple of videos, I will go over exactly what an ETF is, and we'll continue on this topic of diversification. Specifically, why is it important to diversify across geographic regions and markets as well as different sectors? Please remember to like my video and subscribe to my channel if you found content useful and relevant, and definitely stay tuned for more content update on investing and other things. In the meantime, take care and see ya.